From real estate to real life and everything in between. The Brad Weisman Show. And now your host, Brad Weisman.
All right, we are back. We got a good show on record here. I'll tell you what, we do a really good show coming up. We have a guy that I've been talking to for quite some time. He's supposed to be on the show one time. It didn't work out for both of us. And this time he's back. It's an interesting topic. A lot of times people look at investing as being something that is very complicated or is something that, wow, only the people making gazillions of dollars have the ability to do. And I'm talking investing in big real estate purchases. You'll hear the term syndication getting thrown around. You'll hear preferred equity, common equity. And these words are not everyday words. They're not everyday phrases. And sometimes it just scares us. And we're like, oh, I don't think I can do that. But he's going to tell us some ways that we can do that, how everybody that's watching the show could build their life around making passive income. And without any delay, I'm going to bring him on. His name is Darin Davis. He's the founder of Club Capital. Darin, how are you doing?
Hello, Brad. I'm great. Thanks for having me on today.
Absolutely. There for a little bit, it was getting a little sketchy. We weren't sure if this was going to work. Technology was not listening to us.
No, and I think that's where I need to hire high school kids to hold my hand when I start doing anything technology-wise. So
That's right. That's right. So I'm just going to read a little bit about your bio so people know a little bit about who you are. And then we'll start really talking about the equity positions and real estate and all these different things that are really interesting to me. So his name is Darin Davis, an industry leader, real estate entrepreneur, founder of Club Capital. He's got 2 decades of industry leadership, excels in navigating market shifts, guiding investors to exceptional returns. Whether you're a novice or experienced, Darin is ready to share insights on becoming a savvy, passive investor. In 2023, he launched the Never Quit Initiative, educating young adults on private equity, an active and passive cash flow for financial stability. We're now going to talk about, he also says these mottos of education to execution, one of his mottos. Another motto is start now, start small, but just get started. I love that. Joining on this insightful journey is Darin. Darin, thanks so much for being here once again. You have a lot of things here to talk about. And one of the things I just want to jump into is some of the terms like, preferred equity and common equity and these investments that we hear about in syndication. These are terms that I think when people hear them, they get a little nervous and they think this is not something they can get involved in. Tell me how do you jump that hurdle?
Yeah. And it's really, well, and I'm going to give you my life experience and then kind of tell you, and then fast forward to today. I probably did like everybody else. This is in 2000, 2001. I went out and bought a couple single family rental homes. Okay. And found out that could be painful. Just the time it took to manage them. And then I said, there's got to be a better way. Guys are doing this. And then I realized, I kind of learned what a syndication was. And at first, when I heard the word, I thought, well, I'm not part of the mafia. I don't need to be doing something with, something wrong. But I quickly learned that it was just where you had a group of like-minded people that would pool money together and use that leverage to go out and buy an asset that could perform better with less effort. You get the bigger the asset that you have, the margins are about the same, but it's larger. So you're earning more. So I went down that syndication model, and I'll tell you, I was very fortunate that I had a guy here in town that was willing to take me on and teach me. Because I was reading books about it, but I was going like, I don't know what to do here. And sure enough, I started off pooling. My first deal I did with him, I raised $350,000 and we came into his syndication model, and I got to see how the whole thing worked. And why I think that's really important. We'll talk about this, in this show, but I was able to get in small. I had a mentor. There was already a structure, and I was able to learn from him. And we ended up doing 13 of those I did. And every time I did it, I went from 350 to 500 to 750. Yeah. And that was like literally friends and family. I remember the first few phone calls I made. I'm calling, my cousin and my best friend and my colleagues at work that I knew, had some money that they didn't want to get actively involved in anything. They wanted to work off of trust. So that's the whole syndication model.
But are we talking large amounts of, like, you're piecing together $350,000 or whatever you're doing? Are we talking there's 3 people that came up with that money, or are we talking there's 20 people that came up?
No. Those first few deals we did, I mean, I was doing high fives if somebody gave me 10,000. You know.
Oh, wow. Okay. So
I said
this
I
is
want,
doable.
oh, absolutely. 350,000. That was probably 15 to 16 investors.
Wow.
And I didn't want anybody. And I didn't portray myself as some genius or that I had all this knowledge and I had all this experience. I didn't.
Yeah.
But you know what? When you said at the beginning of the show, just get started, start small, get started.
Yeah. Yeah.
You've got to take that first step. I
Yep.
mean, if you haven't experienced the firsthand knowledge and some pain points, you're never going to grow. We all know that in everything we do in life.
Yes.
But these were really small little chunks of money. So, and I'll tell you one thing, I didn't make a lot of money on those first 5 or 6 that I did. I was getting an education. I was getting mentored. I was proving my worth to the investors that I had so that they would go out on my behalf and say, hey, I know this guy, Darin Davis. Here's what he's doing. Here's what he's done. And I made sure that first, 50 investors were just white glove treatment. And that more or less launched me on my own in 2007. So I had that 5 or 6 years where I was working with another guy and doing some small projects on my own, very small. But in 2007, 2008, that's when I started my own syndication and we started raising real money. And that was
an interesting time in real estate.
Oh gosh.
So you could buy things were reduced.
Wait, no, I was the guy that everybody wanted to get the asset from.
Oh, okay.
Yeah, no, I wasn't on the side of buying. I was on the side of God, this is happening to me. No. Yeah.
In 2008, I'll tell you, I always say if anybody was in real estate, which I was heavily, and it was tough. That was a rough time.
That's a whole different story.
That's character building though. And you learned though. I bet you learned a lot during that period.
I can't tell you enough. That trigger point in 2008 with that asset was our first multifamily development. I had no choice but to learn. A guy asked me the other day, he goes, well, how did you underwrite that? I said, underwrite? I said, I'm trying to float above water. I got a gun to my head. Are you kidding me? We're not underwriting anything.
Yeah,
we're scrambling. But we were able to put it together. We got very resourceful. We worked with the city of Austin. We worked with HUD. I worked with a couple of my partners. I remember one of my partners, I love the guy. I called a meeting because I had to tell them that things were not looking good.
Yeah.
He sat in the meeting. We're in this conference room. He sat in the meeting and he came in with a triple scotch on his own. He just walked up and sat down and went through about an hour presentation. At the end of the meeting, all he said to me, he said, Darin? I said, yes. He said, don't lose my effing money. Then he walked out.
Oh, man.
And I went,
that's a little rough.
I know, and the other guys were sitting there, and they all said, "Yeah, me too."
Yeah, me too. Yeah. Without the scotch, obviously, they didn't have the scotch.
Right? No, they didn't. He was the only one. He came in just like, I don't care what you're going to say because I have no idea what you're saying. Just and it worked out.
And the person putting together. So there's the person putting together. So you were the person that was sitting there bringing all this money in. What is the benefit for you then? Do you take a percentage then also? I mean, you're putting in your own money, or you? Yeah,
that's a great question. So what you, and I'm going to give you some basic, terms that would be in the industry. What most people would do is, let's say they're raising whatever dollar amount. The money that comes in from the limited partners that are coming in that are passive, they typically get a preferred return. Okay, so their money day one, they put 100,000 in. Let's say they start earning, let's say, an 8% preferred return. Well, that starts accruing. Okay, because there's no cash.
Right.
Typically, when you are building or you're buying something, you got to put a bunch of capex money into to rehab so that you can. But it is accruing. All right. So then you start making cash flow. Let's say 2 or 3 years, and the operator has to pay all that accrued preferred return first. Okay.
Yes.
So they start getting paid, and then depending on the structure, the operator, sponsor, myself, doesn't get paid till the very end. So you have to perform in what's called a waterfall, and that's all it is. It's like I have to hit certain financial hurdles to my limited partners before I start taking any profits off the back end. Wow. So the incentive for me is to take care of my investors first so that I can get compensated. Yeah. If I can't do that, the way the money flows is the capital and the return go to the investor first and then the operator second or last, typically. Yeah.
And the thing that I look at when I think of these kinds of investment strategies is there has to be a lot of people too, and this is what maybe you can help us looking for. There's got to be people out there that are crooked, that don't know how else to say it, that are going to be trying to do what you're doing, but are actually just taking the money and either embezzling it, or how do we? There has to be a lot of ways of looking to make sure that this is legit. I mean, is that happening?
Oh, it's happening. Yeah. And I would tell you this, there are ways to check backgrounds on people. Okay. And it's worth the due diligence to do that. If you've got you and a friend or two are thinking about doing an investment, there's background checks you can do. It's called UCC searches you can do. You can see if there's any bankruptcies or any liens or anything. You can get a pretty good history on somebody.
Yeah.
And I would really encourage people to do their due diligence on something like that. It's incredibly important. And the other thing is look at the track record. Ask them for the track record. And we'll do this a little bit later, but I have a document. It's called, there's 10 top questions to ask a sponsor. And it's, you cannot ask enough questions. If you don't know, ask. If they get, perturbed at you for asking questions, move on.
Yeah.
Right. Because that's my job as a sponsor, is to answer those questions the best I can every single time, 24/7. And quite frankly, I learn a lot too.
Yeah.
I get questions all the time that I'm going, hey, I don't know that one. Let me go figure it out.
Interesting. Very interesting. Yeah. So let's go into so we put some money in. I say I give you some money. You're the sponsor. I give you some money.
Mhm.
You're saying it takes like 3 years until I'm really going to see any kind of return. Is that correct?
Well, I'm gonna give you two answers. Okay. I hate this when attorneys say to me, it depends.
Yeah. Yes.
But here we go. So from 2012 until about 2021, you could almost do no wrong. Money was cheap, and supply was low because we went through 7, 8, 9, and 10 where almost nothing was built. So we had this hockey stick effect where we had cheap capital and we were undersupplied, high demand. It just kind of nuts. All right. Well, what's happening now on this is that the capital that's coming in is far different than it was, 5 years ago.
Yeah.
And let's take a break on this, Brad. We'll cut this piece out. Yeah. Ask me that question again, because I was looking over here thinking about the next thing I wanted to talk about. Ask me that, and I was going, okay, don't forget that one. Okay, now I'm back. I apologize. Ask me that question again.
Okay, so the question was basically, if I give you 10,000, 20,000, 40,000, whatever it be.
Yeah.
If I give it to you, and what should I expect for return for the you said 3 years or something like that, or?
Yeah, and so typically we were doing development. Okay. And in a development, you acquire the land, build the project, stabilize it. And that takes 2.5 to 3 years. Yeah. And then you would start seeing cash flow or a disposition, a sale. All right. Well, those days are pretty much behind us. That cheap money, low supply. Yeah. So what we're doing now, and the market's driving this, the debt market's driving this, we're looking for acquisitions. Well, because the cost is so high still to build, we have more supply today. So developers, what are called merchant builders, what they do is they buy the land, build it, lease it, sell it, and they move on to the next one. Well, their loans are maturing now. And
I know.
They took them out 2, 3, 4 years ago, were 3.5%, 4%, very cheap. That floating rate's now 8.5% or 9%. Okay. There's no good answer to refinance or go into permanent financing after that construction loan, because that money is still 8, 9%. So what these guys are doing is they're saying, you know what, I would rather go ahead and get out of this and sell this asset and get my investors whole. And if I have to sell it below cost, I have to sell it below cost, but I get to move on and do another deal at a later date. So
I think we're going to see a lot more of that.
Yeah,
we're not even hitting the bulk of that yet. We bring this up in our office with the commercial agents. I think we got another 2 years of that. I think.
I had shared with you guys, just as one of the talking points, we have $600 billion of multifamily debt coming online in the next 30 months.
Are your kitchen and bathroom remodels a little overdue? Well, now's your chance to call First Response Contracting. John Sellers will take care of you. 484-256-7136. They do residential and commercial, and they're licensed and insured. Give them a call at 484-256-7136.
Right.
Wow.
Yeah. So
wow,
it's massive, the amount of opportunities that are going to be there. Now, this is not 2008, 2009.
No, we know that. We know that.
It's not an Armageddon, okay?
Yep.
It's just a supply and demand equilibrium, where we are today. But we have, and we'll talk about this in a little bit, but we're positioning ourselves with what we call some rescue capital to come in and help these developers short term to get over the goal line, to get the property leased up so that they can sell it. And we're putting our investors in a really good position, safety, security, cash flow, short term, so that they can see a transaction happening, and one that we could potentially go buy, because we're sitting there today and we're getting to watch the asset perform from the property management, from the asset management, the demographics around that. So we're getting ourselves in a position, I think back half, probably about mid 2025, we're going to start seeing a lot of opportunities for the next 18, 24 months, and nice opportunities too. Good, Class A, good markets, good demographics, because there's a supply glut right now.
Yeah. And we talk about this in the cities around us. I mean, we're here in Berks County and Reading, Pennsylvania area, and I talk about Philadelphia and New York all the time. A lot of those leases are just going to be, they're going to be coming up to renew, and a lot of stuff's going to be empty. So the thing that I like about that, though, and this is more about commercial than it is about multifamily, but I think it's going to be great, because I think you're going to see also a lot of repurposing into apartments and into condos, because if we don't need all the commercial space as far as office and mostly office, I should say, if we don't need offices because everybody's still working from home, it'd be great for like an investment avenue for like you guys to go in and have an investor go in, take the place and turn it into residential, and turn it into apartments or condos. Is that something that you see that could happen?
In our market, we are so new as a state. I mean, we're only 30, 40 years old.
Yeah.
You guys in the Northeast.
We're old.
You guys have buildings everywhere.
Hey, George Washington was on our street, so it's a little different.
Yeah, I mean, we don't have as much massive office, because you think anywhere from the 1940s all the way up to the 1980s, you guys, Jersey, New York, Philly, all of Boston. I mean, that was the hub of business. So
true. That's interesting. So it is more of a regional area. It's a regional thing for us. Yeah.
I had a friend do one in Minneapolis, St. Paul. He went in and picked up a building at 50 cents on the dollar, and they're converting a third of it into an office building. Nice one. Yeah. They're converting a third of it into all condos.
Amazing.
That's
what we think we're going to see here. I think that's what we're going to see.
Think we will. Yeah. That's not our wheelhouse. I'm not an expert on that at all.
That's all right. That's all right. So what did you want to, you said that there's something else you wanted to get into that you were thinking about. Do you remember what that was this week?
I kind of want to share with your guys. I mean, if you're looking for a way to get exposure to commercial real estate and multifamily, and I'll tell you a little bit about us so you can kind of see what we're doing. We're focused in Texas and Florida, and we like those because of net migration, jobs, affordability, all that. So we still have a lot of growth going on here, but anywhere in the nation this is going on, there is the way that deals were financed. You typically had bank debt, and then you had what's called common equity, or just equity would come in and they would syndicate that, get a group of people and they'd put the money in, and the bank debt was usually 70% and the equity was 30%. And that was the 100% of the money was what's called a capital stack, and you'd go out and, the sponsor would do their thing. You would fund the project, you'd do your thing, the returns would come in, and you move on down the road. Well, what's happened now is the values of things have come down. The leverage has come down, meaning, leverage meaning you want as much cheap money from the bank as you can get. Everybody wanted that 4% money.
Yep.
That's gone.
Yep, that's gone.
So that bank debt has gone from 70% to 50, 55. And now the investor is sitting here, or the sponsor is going like, okay, I've got this gap. My common equity is over here. My bank is over here. I've got to fill the money somewhere. What happens is they look for short-term funding. Well, what we're doing is we got multiple calls a year and a half ago going, hey, you guys have been raising equity for us. We need some money today to get over the goal line. So what that is, it's called preferred equity, and it's rescue capital. All right. And you're rescuing the developer. So we go in and let's say we put in $4 or $5 million. Well, we're not common equity, meaning we buy a percent of the deal and we get the upside and the preferred return. And, if it hits a grand slam, they get a big payday. We're going in and say, okay, we'll give you this $4 or $5 million. We're going to get a contracted return. And it's like a second loan. I mean, people know what a second loan is.
Absolutely.
It acts like that. But what happens is that we put our money in and our investor gets anywhere between 12 and 14% annualized.
Wow.
We are our investors, us, we are paid off before the common equity is. So when that asset has a recapitalization for new money, a refinance goes into permanent loan for long term, our money gets paid, our capital and our return gets fully paid before that common equity gets paid. So you have that safety net of money behind you. Now you come in at preferred equity, you get to watch the deal. I mean, you're on the front row. You're getting to watch what's going on there. So you get to learn quite a bit on how this asset performs. You get all the monthly reports, quarterly reports,
awesome.
The financial. It's super safe because all the common equity is behind you. So
the common equity are the partners in the actual original corporation or whatever, right? Correct. That's the common equity.
Yeah, you got that right. Exactly.
And the preferred is basically somebody coming in temporarily to help out the situation, to get it built, to get it profitable, and then they get their money back. Is that right?
You're exactly right.
Okay.
Yeah.
See, I'm actually getting this, Hugo. I'm actually starting to understand this.
That's right.
Yeah. But I tell you what, and we kind of mentioned this before we jumped on the show. If I had a pref equity solution 12, 13, 14 years ago and gave that to my new investors, new investors would have learned a lot in 2 or 3 years, and they would have had a much easier transition into common equity. But today, and we haven't had to use common equity in 14 years, 15 years, because money's been so cheap.
Yeah.
So today you can't make a common equity deal really pencil. I mean, there's going to be that unicorn out there. But this preferred equity allows you to get into the deal. You may say, I'm in and out in 2 years, 3 years, whatever the terms are that we contract, but there's just not a lot of common equity opportunities. And you don't want your money sitting there with inflation. I don't care what they say. Inflation is, 8, 9, 10%. It's not 3.
No, definitely not.
So
go to the grocery store. That'll like
that'll
tell you what's going on.
Yeah. So no, but anyway, it's such an easy way for investors to come in and get some short-term money. I mean, short-term commitment, earn 12, 13, 14%. And then when the deal is transacted for the new debt, you get paid off. And that's contracted. The whole thing is contracted with the sponsor.
You know what's really interesting about this? Because what like you had said, and I just never thought of this until you said it, is that as the lending rate goes up, you have to be creative in getting other people to come up with the money in order to be able to do the project at an affordable cost. So when the bank rates are at 8%, 9%, whatever it is, say what you've done is you've found a way to bypass having a lot of bank debt.
Well, and it's expensive though. I tell you, but it's really short term, and it's usually
right. But it's short. That's what I'm saying. But it's short term expensive.
Yes,
but over the long period, over the long term, then once after that's paid off, then it's gone at that point, which is
here's just a quick example. One of our construction loans is $40 million, and it's paying 8.5%, 9%. That's expensive. The other one is $4 million, the pref equity at 14%.
Yeah.
So you can see the total cost of capital is far lower for the sponsor. He's going, man, give me your short-term 2-year 14% money. That's far cheaper than my, going out and paying 9% over here and adding it to my 40 million.
Yes, I 100%. That's what I was right there. So just because for time, I do want to get into you're doing this nonprofit that I wanted to talk about. It's called the Never Quit Initiative.
Yep.
Can you tell me about that?
Yeah, I have. My mom's a teacher. Okay, and so
my wife's a teacher. So.
Okay, yeah, my mom was 37 years, and then she became a principal and all that. But I grew up with just education constantly.
Yes.
And then when I think in right around 2000, 2001, I made some changes because I said, I've got to do something different because I was a W-2 employee. I was traveling Monday through Friday. I was making great money. I was out in San Jose and San Francisco working in the software world. But I said, I can't continue to do this. And I've got to do something different. And I started looking into real estate. I found real estate. I found, the loans were good. The taxes were good. So I pivoted into that. Well, the girl that I was dating at the time became my wife. And we said, hey, if we're going to do this, because she loved it too. I said, let's move back to Texas where family is.
Yeah.
So we went through all this and we started realizing how little education there was out there for what we're talking about. And you've got adults that are going to listen to the show and watch the show, and they still have not been exposed to some of the things that you and I are talking about. And then there's so much more. And I just said, someday I want to put a program together to really work at the high school level or the college level about real world investing, not stocks and bonds. Anybody can do that. But how does real estate and other types of alternative assets, how do they work?
Yeah.
Well, the Never Quit initiative was really driven by my wife, who passed away of cancer.
Oh, I'm sorry.
Yeah. And but she never quit, and that's the whole thing. And through the whole process of her helping us build cash flow, when she got sick, we didn't have to give up the world or go bankrupt or lose our home because we had spent 10 years building up cash flow that actually saved our life. Because if we had not have had that, and we saw people that were just straight up W-2, didn't have anything else going on as we're going through the cancer treatments and the chemo treatments and all that, I saw families just get devastated.
Yeah, it happens a lot.
It just killed me.
Yeah.
So after her passing, and just a year and a half ago, my kids and I decided that we want to. Now they understand. They're just now old enough to kind of understand what's going on and how it happened and all that. But we decided to set up the Never Quit initiative. It's new. I'm going to be working on it more, but it's really going to be designed for education, the power of cash flow. A lot of people say cash is king. I say cash flow is king, period.
Yeah, cash flow. Yeah. Mm-hmm.
Yeah. And then, in her name, if we do that, and then part two of that is that we saw families lose their homes when we were going through, all this stuff. And I said, if I can ever keep a family together, if I can ever help pay their rent or their mortgage, through this period, I said, that is something I can't imagine a family being vacated from a home while they're going through stuff like that.
Yeah.
So the education side and just the support side. And so we're going to get real active with it next year. We have quite a few friends and family have donated to it. Understanding that. So it's in her name, and I'm just now at a point where I can talk about it. If you had asked me this question a year ago, I'd have had to say I can't really talk about it. But we're there. It's exciting for us, and it's something we're really passionate about: the education and the support we can do for a family.
That's awesome, man. I really like that. That's a great story, and I didn't realize that's where it came from. But I'll tell you what, we're at 28 minutes. We got to wrap it up. We'll probably have you back if you're into coming back to talk more about this stuff. I want you to stay in touch with us, and actually with the Never Quit initiative, get us more information on that from time to time too. I would love to stay up to date on what's going on with that. Share it with our audience and see if anybody would be willing to contribute towards that also. So thanks so much, man, for being on the show. Really appreciate it. Is there anything that you want to leave us with at the end of the show?
There's a couple things that I see over and over and over again. People, if I talk about the education without execution is just entertainment. I don't know if you've ever heard that.
Yep.
Yeah. You're going to make mistakes. Okay. You are absolutely going to make mistakes, but the sooner you make them, the better off you're going to be. Take that first step. It changed our lives with my wife. I kid you not. We were so lucky that we had spent 10 years building that up. Because if we hadn't, I don't know what would have happened to us, but we survived, and we're flourishing, and everything's good. So I'll leave your audience with that.
Amazing. Great story. Great story. Thanks so much. Love the contribution. It's amazing.
Yeah.
All right. Take care.
Okay, man. We'll see you.
There we go. All right. Darin Davis. Seriously, if you're looking him up online, just look up his name. You can find him anywhere. He's got socials everywhere. And the company is called Club Capital. And if you have interest, there's a lot of places on his website that you can get information. You can ask about being an investor. They'll guide you through the whole thing. So there you have it. All right. We'll see you next Thursday, 7 p.m. Thanks for watching.